Hi everyone, you are watching Commerce Crunchers. If you like my videos, please subscribe my YouTube channel and hit the bell icon for a regular update. Today I am going to explain about what is meant by accounting cycle and basic terms of accounting. Let's start with the accounting cycle. Accounting cycle means when completely sequence of accounting procedure is done which happens frequently and repeated in same direction during an accounting period. The same is called an accounting cycle. Accounting cycle is a complete sequence of accounting process. Okay, it's a complete sequence of accounting process, complete sequence of account which begins with a business transaction, and end up with a final account which are repeated in same direction in each accounting period, which is repeated in same direction in each accounting period is called as accounting cycle. Next we have to move on accounting process. The first one is business transaction, second one is journal, third one is a ledger, fourth one is a trial balance, fifth one is a final account. First one is a business transaction. When transaction happens, it is first recorded in the subsidiary books. Subsidiary books are purchase book, sales book, purchase return book, cash book, etc. Okay, these are the subsidiary book. When the transaction happens, we have to record it there. Then we have to move on to journal. The transaction are recorded in journal chronologically, step by step we have to record it in journal. Then we have to move on ledger. All the journal are posted into a ledger chronologically in a classified manner. Okay, all the journal are posted into ledger in a classified manner in a chronologically. Then we have to move on trial balance. After taking all the ledger account closing balances, a trial balance is prepared at the end of the period of financial statement. Then we have to move on final account. Final accounts are profit and loss account, and the balance sheets are the final account. We have to prepare here. These profit and loss account balance sheet, the profit and loss account shows how much the company earned the profit, how much company incurred loss. In balance sheet we have to know what are their assets and the liabilities of the company. These are the process of accounting cycle and what is meant by accounting cycle. We have to move on basic accounting terms. Basic accounting terms. First one is transaction. It means an event or a business activity which involves exchange of money or money's worth between a parties is called as a transaction. Transaction are always measured in terms of monies or a money's worth. For example, purchase of a goods. Okay, purchase of goods. It involves receiving a material and making a payment. Lastly, what we have to do, making a payment. So that's why I'm said it's always measured in terms of money or a money's worth. There are two type of transaction. One is cash transaction, another one is credit transaction. Cash transaction means the parties settle the payment immediately after buying an goods is called as a cash transaction. Credit transaction means the payment settled on a future date, like before a month, before the year, or after the year. According to their agreement, they have to be settled their payment is called as a credit transaction. Next is goods or a service. There are tangible article or a commodity in which a business deals. That's called as a goods. Service are intangible in nature, which are rendered with or without the object of earning a profit is called as service. Services are always tangible in nature. Goods are differ from one company to another company. For example, a mission manufacturing company produces missions. In a mission manufacturing company, what is the goods? What are their goods? Mission. They are producing the missions. So missionaries are their goods. They sold to another company. The mission are sold to the XYZ company. The XYZ company prepare using the mission to prepare their chocolate. What is their goods? Chocolates are the goods. In the manufacturing company, missions are the goods. Now XYZ company, chocolates are the goods. So that's why I told it, the goods are differ from one company to another company. Services are intangible in nature, which are rendered with or without the object of earning profit. Always services are intangible asset. We cannot touch it, but we can feel it. They had to be render their services with or without the object of earning a profit. Okay, this is called service. Next is profit. The excess of revenue income over the expenses is called profit. A person as a the person during an accounting period, they generate a more income than the expenses is called profit. Profit is always good to the companies. Loss. The excess of expenses over an income is called loss. During an accounting period, the company make more expenses than the income. They have to make a excess of expenses over an income. They generate a less income, but they have to pay the excess of expenses. So that's why the company make a loss. Asset. Asset is a resources owned by the business with the purpose of using it for generating a future profit. Assets are always a resources to the company or resources to the business for making or producing any goods. They require asset, and the using those asset they have to generate the profit. So that's why assets are very important to the every business. There are two type of asset: tangible asset and intangible asset. Tangible assets are a physical existence, which have a physical existence, like as plant and machinery, building, computer, books. They are all tangible asset. For using all those things, we have to generate the profit. Intangible asset, they have which have no which have no physical existence, but it generate a profit. They have intangible assets are goodwill, patent, intellectual properties. They're all are intangible asset. Next one is liability. Liability means it is next one is liability. It is an obligation of a financial nature to be settled at a future date. Liabilities is always an obligation to a person. Okay, for example, when a goods bought on a credit, here we have to pay the cash to the supplier on a future date. We have to pay the cash to the supplier on a future date. So it is always liability. We have to pay before an year or after an year. We have finally we have to be paid it. So it is always liability to the company. There are two type of liability. One is current liability, another one is non-current liability. Current liability means the liability is not exceed 1 year. It is always before the year we have to settle their payment. Non-current liability means it is exceed, it's more than a year. It is exceed more than a year. On the basis of their agreement, they have to be paid it. The company will be paid it. It's called as liability. Capital means it is an amount invested in the business by its owners. The amount is invested in the business by its owner. The owners are invested the amount in a different sectors, like purchasing a machinery, purchasing a raw material, and also kept some of the amount for the futures, kept the sum of the amount in for the future purposes. They all are asset. The business owners has to be invested their amount. With the help of all, we have to run the business. We have to generate the profit, or we have to produce the goods. They are called as capital. Drawings. Drawings it represent an amount of cash or a goods or any other asset which the owner withdraw from the business for his or her personal use. Here, the owner of the owner, the owner, uh, the owner withdraw from the business for his or her personal use. Here, the owner are withdraw the money from the business for his or her personal use, not for the company purpose, for the purpose of his or her personal use. For example, life insurance premium. Life insurance is for the purpose of his or her for family use. So they withdraw their amount from the business, they use it for personal purpose, is called as drawings. Life insurance is not considered as a company's. Okay, life insurance is considered as a company's property? No. Fire insurance is considered as a company's insurance. Life insurance is always made for their own life or for his or her family life. So the company owners has withdrawn the amount for his or her personal use is called as drawings. Next one is debtor. The sum total or aggregate of the amount which the customer owe to the business for purchasing a goods on a credit. Here, debtor are the customers or the debtors here. The customer purchasing a goods on a credit. For example, the customer purchasing a goods on a credit. Here, the customers are the debtors here. The customers are paid to the company. The customers are paid to the company on a future date. Okay, they are called a debtor. The customer owe to the business for purchasing goods on credit. So who is a debtor here? The customers are the debtors here. These debtors may be again classified as under good debt, doubtful debt, bad debt. Good debt means they settle the cash within a year or according to their agreement. Doubtful debt means it may be doubtful whether maybe has to be cleared their debt or they are not declared. It is doubtful. It's always doubtful. May or may not be. Bad debt means he or her not cleared their debts. It is always lost to the company. Bad debt. Next one is creditor. A creditor is a person to whom the business owes the money or a money's worth. Here, the company purchased the goods on a credit facilities. Here, the company will pay to another person on an agreed period. Is called as creditor. Here, the company is to whom the business owes the money or money. Here, who is a giver here? They are the creditor here. Who is a giver? Supplier the giver. So who is the giver? Who is the give to the money to the company? They are called as creditor. These are all the basic terms of accounting. Next we have to move with another important topic. Until then, take care. Bye bye.